This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 19 May 2026.
Thank you for having me.
So today we are taking a deep dive into something that, well, it might seem fairly routine at first glance, but the operational mandate is actually remarkably strict.
Right, extremely strict.
We're talking about the legal and operational governance framework of Luxembourg shareholder loans, specifically within private banking and family wealth files. Our mission for you today is to unpack exactly how rigid this framework really is.
Yes, because, you often see situations where, say, a family office wires 10 million euros into their Luxembourg holding company, right? And they just casually label that transfer a shareholder loan in an email to their accountant.
Which happens all the time.
Exactly. But then months later, that holding company goes to a bank for leverage, and the credit file just entirely collapses during the bank's review. The bank halts the financing.
And suddenly the tax advisors are raising red flags everywhere.
Precisely. Because at the end of the day, a label just isn't a legal reality. You have to engage directly with the precise civil law and regulatory architecture.
Right. So let's distill this for the listener's practice. What are the concrete must-knows if you're looking at one of these files?
Well, there are three core takeaways here. Number one, a shareholder loan is only legally recognized as debt if four elements are perfectly clear.
And those four are?
The repayment obligation, the maturity, the interest, and the creditor identity. If those aren't clear, it's not a loan.
Right. Okay. And the second takeaway?
Number two is that subordination requires express drafting. So informal labels in an email or, a note in an internal accounting spreadsheet, those are legally insufficient.
They hold no weight.
None at all. And then number three, which is crucial, perfect alignment is mandatory across 5 pillars.
5 pillars. Okay, let's list those.
You need alignment across the civil law documentation, the accounting treatment, the tax sensitivity, the credit governance, and the AML/KYC reviews. They all have to match perfectly.
Okay, let's unpack this. We have these 3 incredibly rigid rules, but to really understand why they are so strict, we need to look at the foundational legal architecture.
Exactly, because we have to ask who is involved and what the legal mechanics actually are.
Right. So who are the main actors here?
Well, you have the Luxembourg companies receiving the funds, obviously. You have the shareholders providing that funding, the directors executing the corporate approvals, and critically, the reviewing private banks.
Right, the banks assessing the risk.
Yes. And under Article 1892 of the Luxembourg Civil Code, a shareholder loan is fundamentally a repayable advance. The borrower receives an asset like cash and must return the exact same amount of the same kind and quality.
Wait, let me stop you there just to get this perfectly clear. How does that strict return the exact same amount logic under Article 1892 definitively separate this instrument from, say, an equity injection?
That is the pivotal distinction. With an equity injection, the shareholder takes a participation in the corporate entity's risk and reward. Right.
Right. So the return depends on performance.
Exactly. Distributable reserves, dividend declarations. But a loan under Article 1892 is legally agnostic to the company's performance. The legal imperative is to return that exact quantum.
So if I loan 10 euros, I am legally owed 10 euros back, even if the company makes millions or goes bust.
Precisely. It creates a strict creditor-debtor relationship, which is entirely separate from the shareholder-company relationship, even if it's the exact same person wearing both hats.
Which explains why the documentation has to be completely flawless. So that's the civil law side. But when this file hits a private bank, you're dealing with credit officers and regulators.
Right, and that introduces a whole new layer. The banking risk layer is driven by the expectations of the CSSF and the European Banking Authority.
So what's the regulatory framework practitioners need to be looking at right now?
You have to operate under Circular CSSF 22-824. That applies as of 31 March 2023 for Luxembourg lending governance.
And why did the CSSF formalize these specific expectations? Like, what's the actual systemic risk they're addressing here?
Well, Poorly documented intragroup funding creates invisible leverage. If a bank doesn't know exactly when a shareholder can legally demand their money back, the bank can't calculate the company's liquidity risk accurately.
Ah, I see. So the bank might think the company is solvent, but the shareholder could just pull the capital the next day because the loan was technically on demand.
Exactly. And
Right.
that's why this framework ensures absolute operational clarity.
Okay, so how do you actually structure the file to give the bank or the auditor that undeniable operational clarity? What exactly needs to be in my folder?
It's a strict three-point architecture. First, you need a signed loan agreement. It must specify the principal, maturity, and interest.
And there are specific civil code articles for that, right?
Yes, Article 1905 permits interest to be stipulated. And if there is no fixed term, Article 1900 becomes critical because courts may then determine the maturity.
Right. Okay. And the second point.
Second, strict corporate approvals. The board has to formally acknowledge the debt. And third, if it applies, an express subordination clause.
So what does this all mean for the actual operational sequence? Because in reality, wealth managers throw the term shareholder loan around all the time.
They do, yes. But the practical question is never what the instrument is named. The only question is whether the instrument can be diligenced.
But it's about diligence over labels.
Absolutely. You have to execute the terms, take maturity, for example. You have to contrast an on-demand loan profile against, say, a fixed-term subordinated loan.
Because an on-demand loan creates immediate repayment pressure that the bank has to factor in.
Exactly. And then you have the interest. The interest defines the economics, it defines the accounting treatment, and of course, it dictates the tax sensitivity.
Right. And you mentioned subordination earlier. If I want the shareholder to stand behind the bank in the queue of creditors, how do I actually execute that?
You have to do it contractually.
Right.
Changing that creditor ranking requires express drafting. You cannot just rely on an informal understanding.
This has to be codified.
Yes, or it's legally meaningless to the reviewing credit committee.
And I imagine the execution costs for all of this can vary quite a bit.
Oh, definitely. The cost and specifics depend entirely on the jurisdictions involved, the complexity of the approvals, and whether you're attaching security documents.
Okay, so let's shift gears slightly and look at the context. How are the authorities treating these structures in practice right now?
Well, from a tax perspective, the Luxembourg Direct Tax Authority's Circular LIR number 56156-1 is a critical consideration.
Right, because we're dealing with intragroup financing.
Exactly. So you have to ensure arm's length remuneration. The interest rate has to withstand scrutiny.
Okay, but monitoring the market pulse overall, we haven't seen any structural regulatory shifts in the last 48 hours, have we? It seems the market is just purely focused on execution.
That's right. Purely execution.
What about AML and KYC? I know sometimes people talk about crackdowns or trends in compliance.
Let me stop you there because we absolutely cannot use terms like trend or crackdown when discussing anti-money laundering and counter-terrorist financing.
Right, because they are permanent.
Yes, they are permanent, immovable, structural pillars of the control environment. You have to verify the source of funds, the source of wealth, the transaction purpose, and beneficial ownership.
Every single time.
Every single time. It's structural.
Okay, so looking ahead, what confirmed dates do practitioners actually need to mark in their calendars regarding shareholder loans?
Objectively speaking, there are no officially scheduled shareholder loan-specific milestones right now.
Nothing on the immediate horizon.
No, any future legislative or regulatory developments targeting these specific structures are currently to be confirmed. The focus is strictly on mastering the existing framework.
Okay, here's where it gets really interesting for your live files. Let's pull all of this together into a concrete execution scenario.
Let's do it.
So imagine a Luxembourg holding company is seeking private bank financing. But the accounts show existing shareholder funding.
Right, a very common scenario. So, as the practitioner, your immediate task is verification. You have to verify the principal, the maturity, the interest, and the exact creditor identity.
And the AML pillars too, right?
Yes, the source of funds, the repayment mechanics, and any subordination undertakings.
So the critical action here is aligning everything.
Completely. You have to align the loan agreement, the accounts, the corporate approvals, the onboarding notes, and the credit memorandums.
And you have to do all of that before the bank relies on the file.
Exactly, because what is the payoff? The payoff is a clean file. The instrument becomes legally intelligible as debt,
which allows the bank to actually properly assess the leverage.
Yes, without having to rely on, informal, out-of-band explanations from the client's counsel.
The documents just speak for themselves.
Precisely. They meet the strict requirements of Article 1892 and the expectations of the CSSF.
Which is absolutely essential. Luxembourg is particularly relevant because cross-border private wealth structures frequently combine Luxembourg companies, international shareholders, regulated banking relationships, and balance sheet financing in one operational file. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.